Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett Fu, we're looking at a little bit of a relief rally here.
Yeah, after a brutal sell-off on Friday.
Absolutely brutal. Let's get to the biggest stories right now in the nearly $20 trillion global ETF industry. And the S&P 500, it is higher on the day, giving back some of its gains, though, after Iran's parliament speaker says that no negotiations have been held with the United States.
And with all this market volatility, in just a moment, we'll be speaking to Tushar Yadava of BlackRock on the firm's $220 billion model portfolios, staying firmly risk-on and maintaining their overweight position in stocks.
And we'll also speak to Joel Schneider of Dimensional after the firm launched these industry's first actively managed share class ETF. It finally happened, but all that and more coming up. As always, though, Eric Balchunas from Bloomberg Intelligence, he's here with us now, and he's looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you. So the flows have a little bit of there's a lot of rebalancing going on. So some of this is a little bit not exactly sentiment, but a lot of money into IVV. We don't totally know what this is, but that's a lot. Probably a model rotation, could be tax related. VU, $4 billion. I mean, look, VU takes in money like this every week. By the way, the year-to-date total for VU is now $55 billion, and it's not even the first quarter. So you do the math, you're looking at over $200 billion for the year, which would destroy the record for a single year. You know, the headlines can be scary, but these Vanguardian type investors just keep putting money in left and right, just like last year. We'll go over that in a minute. Let's look at the outflows here for a minute. There is some trading crowd outflows here. So the ones they like SPY, seeing a little bit of outflows. Also EM, some money coming out of that. This is interesting. Both of the big gold ETFs seeing outflows. You know, a lot of people were kind of dumping on Bitcoin for not being the safe haven store of value about 2 or 3 months ago, and gold was. Well, the roles have been reversed. I think you shouldn't really judge these assets over a couple weeks or months anyway. So I think both are store of values. One's just a little more sturdy, one's a little younger, but you know, they work in different ways. They're more like zero correlated, not inverse. And then we have money coming out of high yield as well. Let's look at the U.S. versus international scene. This is a big deal last year. People thought, okay, we're going to leave America and go to international. And this is a chart that my colleague Athanasios made. This is global international 3-month rolling flows, okay? This is U.S. This is when everybody said sell America, and we were like, that's ridiculous, right? Everybody's buying into America big time. This was during the tariff tantrum. Nobody really cared. They kept buying America. But it has kind of played out a little bit this year. You can see that generally this has gone down and this has gone up. So the gap here between U.S. and international global is pretty narrow. And it will be interesting to see how this Iran affects that. We did a study, looked, and usually U.S. does better after this geopolitical conflicts. But we will see. U.S. stocks may be a little exhausted. I'm sure we'll talk about it in 1 second, Katie.
Absolutely, Eric. Thank you. Let's keep the conversation going with Tushar Yadava. He is head of markets for Model Portfolio Solutions over at BlackRock, sitting on set. Tushar, it's great to see you.
Thanks so much for having me.
So Eric was mentioning all of the rebalancing that is potentially going on. So let's talk about what BlackRock is doing, of course. You have about $220 billion on your model platform. Earlier this month, you put through a big rebalance, and you're still overweight when it comes to equities, but I know that you tweak some things when it comes to that allocation.
Yeah, obviously great time to sort of be talking about being overweight stocks when there's a lot of risk in the market. But I think our goal was to try and look through what was going on more broadly and think about it as what are the conditions that we feel comfortable about taking risk. And that's being overweight equities because higher earnings engender higher stock prices, as we believe. The outlook for earnings is really, really strong at the moment. Globally, it's also, seeing that kind of uptick. And I think the ability to do that is backed up by what we did in the bond portfolio, which is to just trim some areas of risk, really lean into the sort of the treasury component of the bond portfolio as kind of the ballast and allow us to stay risk on and think about where we are in equities, cutting down some of our active bets, which allows us to keep that 3% overweight, but keep it in a more meaningful way for us.
All right, so let's talk a little bit more about what you're doing within equities, because you were super heavy on the mega caps, the big cap companies, and you're being a lot more nuanced about that now towards underappreciated and improving fundamental stocks. What does that mean? Value stocks?
It doesn't mean value specifically. I think it's more breadth by cutting down our exposure at the very, very top end of the cap range in a very narrow set. The 2023 to 2025 that you kind of know and loved is probably gone. There's a lot more breadth being played across the equity market now. And, you know, quote the 50 Cent line, many men wish breadth upon me. So it's finally here, right? And how do you think about that? Well, for us, it's just been taking down our exposure at the very top end of the cap range, playing a broader set of winners, but staying within the same themes that we think are very, very strong in the portfolio. The rise and the dominance of AI, companies that are using it versus companies that are not, and seeing those beneficiaries in a broader lens rather than in the narrow lens of maybe a few companies at the top of the cap range.
So you are very interesting to me because you're running a full portfolio of all different asset classes. Most of the PMs you see on Bloomberg TV are managing equities, so they're worried about like Amazon versus Google and such. But you have to deal with, like, do you go to cash? You know, do you go to international? These are big questions, and you know, you read these columnists and they're like, oh, it's so over. You know, every other week it's over. You clearly are ignoring those headlines. You're staying invested, but do you get pressure from your own investors who are like, look, man, these headlines are scary. You need to go to cash or do something?
Yeah, our PM team is fortunate in that we're managing to a very sort of diverse, broad index, and generally our client base, our advisors, really value the ability to stay invested but keep risk on in a meaningful manner. I think going to cash is something that's great for headlines. It's probably not good for advisors or advisor portfolios. It's certainly not a good thing to do for the end investor. And whenever you do see those opportunities or the sort of headlines whirling about going to cash, the majority of instances you end up with really good gains immediately afterwards. And I think most investors have learned that lesson, which is why they've learned to stay invested and learn to stay in portfolios like ours.
Well, someone keeps going to cash because you take a look at money market fund assets right now, nearly $8 trillion, which is just staggering. But Tushar, you're about 3% overweight when it comes to equities right now. You've been at that level for a while. I'm just curious, I mean, when was the last time you were underweight, and what's the max overweight that, you know, you've been comfortable going to in this model?
3% is closer to the top end of the range. We've been as high as 5%. 5% is where we'll top out at generally. And on the underweight side, we've been underweight before in the past. I think there are certain instances our portfolios are allowed to tactically rebalance based on incoming market information. So in March of 2023, I think it was, when there was the regional banking issues that were going through the system, we went underweight and we took out all of the financial risk that we had in our companies, small banks, mid-sized banks. And so we were taking those out of portfolios tactically and went underweight equities for a brief period of time. It's something we can do. By and large, though, our portfolios and the way that our PM team has set things up is that we're going to try and beat the market when we think that market risk is worth taking. And that's what we see at the moment. We see a good environment for taking market risk, absent, obviously, the headline stories that are going on around us. But if we look through that and look at fundamentals, we see a very sort of positive backdrop for adding to earnings or adding to equity risk and keeping equity risk at a 3% overweight level.
You had mentioned earlier fixed income as a ballast within the portfolio. Where does that leave gold? Where does that leave crypto even as, you know, some of those ways to make sure that they balance out your portfolio?
It's a great question. We've had gold in our portfolios for a couple of years now. I think if you ask anyone on our PM team, the range of answers that we'd have given you of what we'd have expected as price return from gold would not be the plus 100% that it has been now. And so I think with that backdrop in mind and thinking about returning to keeping the bond portfolio more as a ballast, which is where we funded our precious metals from, we've looked at trimming back that gold hedge. And so that's what we did in our latest rebalance. It's still in portfolios, but anytime your hedge rallies about 100%, you've got to think about defining that hedge a little bit more.
So in this world, model portfolios are getting bigger and bigger. They're a bigger chunk of the flows. Cerulli says they're about 3 trillion, so about 22%. Do you agree with that, and do you think that number is going to grow?
We think that number is definitely going to grow, and I think we're positioning ourselves to make sure that we continue to see that growth. A lot of that growth is coming from what you offer as a model portfolio provider as well. We run through our custom models business, and I think we're probably the founder and the leader in that custom model space. Over 4,400 different model portfolio families. Offering customization, offering breadth, offering scale is the reason that it's growing, and it's the reason that we're seeing that kind of growth that we're having at the moment.
All right, Tushar, thank you so much. Tushar Yadava of BlackRock, and this is ETF IQ on Bloomberg. market volatility remains, financial anxiety is at an all-time high. Yet, you look at optimism for the long term, it is enduring. So joining us now is Dan Egan. He's going to put this all together because he is Vice President of Behavioral Finance and Investing over at Betterment. And Dan, I guess one way we can start to explore what the psychology of investors is right now is to hear from you about how they are directing their investments when they're doing it themselves, when they're making their own decisions as opposed to following along their managed portfolios. What are you seeing from your investor base as they navigate this volatility?
So some people may not know, Betterment is a managed portfolio, or has been a managed portfolio product for a very long time, where we manage the portfolios for you, much like your previous guest. About 6 months ago, we rolled out the ability for clients to manage their own investments, set the trades themselves, and so on. And of course, there's a question of like, if you've got a well-diversified ETF portfolio over here, what are people going to do in their self-directed holdings? We're now months in, and I went in this morning to check, and I want you guys to actually guess, what do you think is the #1 holding that people have chosen to trade themselves?
Man, that's a great question. I'm going to be really bearish and say cash, but...
Gold.
Yeah, that's a good one.
Bitcoin?
Bitcoin? I like it.
Okay, so we've got Bitcoin, cash, and gold. Yeah.
Popularity, #1 holding, VOO.
Oh, okay.
There you go. Vanguardian impulse.
I think there's a lot
of
of
America's trade.
It's the safe bet, right? And maybe it's a matter of market timing. They want to know when to get in and out, and it's still a great vehicle to do that. I've been pleasantly surprised about what our customers are doing. It is really interesting. It actually goes back and forth between well-diversified ETFs. We've got VOO, we've got VTI, we've got QQQ, with things that are very similar to them nowadays because of the sort of large cap growth. So you've got NVIDIA, Amazon, Google, Apple. The top 10 holdings read like the top 10 holdings of the market, sometimes inside of an ETF, sometimes going direct to the stock.
Dan, related to this, we were looking at your the biggest buys for Betterment over the past quarter in your 13F. And it was interesting, the top buy, speaking of VOO, is SPYM. This is State Street's sort of answer to the other three S&P. It's 2 basis points. And I know you're a Vanguardian at heart. And I have to think, are you replacing VOO with SPYM to save that basis point?
We love how markets are so efficient that this is what happens. I'm perfectly happy. I don't know the economics of it, but I know that it's good for our clients if we're lowering their expense ratios, as long as it's done as sort of a responsible, you can trade it, it's liquid, there's no sort of hidden tax consequences. The investing team looks at this on a quarterly basis and says, what's the best offering out there right now? What should we be putting people into? And if they choose SPYM, there's a very good reason for that.
I do want to go back to, the self-directed portfolios. It's fascinating, again, that VOO has been the most popular choice. What are you seeing in terms of activity, in terms of turnover? Because, you think about sort of traditional model portfolio, it's rebalancing maybe a couple times, a few times a year. How active, though, are these sort of self-directed investors?
It's actually really interesting. So let me nerd out for just a second. One of the long-standing things we've known about self-directed investors, starting from the 1990s with self-directed brokerages, is that they're actually not bad at timing their buys. And so far, Betterment customers have been net buyers into the self-directed holdings, and they've been pretty good at timing what they buy. On the other hand, where you tend to see some problems where performance tends to lack for individual traders is on the sells. And I have to say, we've not had enough data. It's not been long enough for me to say, like, are they timing their sells as well as they're timing their buys? However, the buys have been opportunistic and a little bit more linked to how markets are moving and how those individual stocks are moving than are the managed portfolios that we manage for them.
So, Dan, you talk about Gen Z and how they've been trying to do their own stock picking, and they're kind of like throwing their hands up, and they're like, you know what, this is actually hard. I'm just going to, I just want to chill and buy an index fund. On our team, we have a phrase that today's the Gen is tomorrow's Vanguardian. It happens to the best of us. Is that what you're seeing with the younger generation? Are they starting to go from that sort of day trading lottery ticket mode to buy and hold?
So, the Ferris Bueller life comes at you pretty fast. I feel like for each generation, life is coming at them a little bit faster. So go back, gosh, was it a decade now? And I say we had the meme stock craze, your AMCs, your Blackberries. And I think a lot of people, because either it was COVID or it was the focus on the meme stocks, a lot of people kind of had their early first hazing ritual about stocks early. It brought everybody into the market. They did a lot of self-directed investing. They got engaged. They're like, how does this work? Okay, I can do this. I've demystified it for myself. Maybe I don't want to keep doing this. Maybe this is actually kind of boring and I've got better things to be doing with my time. So in general, I think there's a kind of interesting growth curve every generation goes through, and it's a question of when and how quickly do they hit it, where it's like, I'm interested in this because I hear it being reported in the news, or I have friends who have gained access to it. I want to experience and get exposure. You do it, and very quickly you go through the school of hard stocks and you learn that maybe this isn't quite as easy as you might have heard about.
Right.
And you say, investing is good. I want exposure to the growth, but I don't want to have to be on top of it every single day.
All right, Dan, got to leave it there. Great to get some time with you. That is Dan Egan of Betterment. This is ETF IQ.
This is Bloomberg ETF IQ. I'm Scarlett Fu along with Katie Greifeld.
And it's time for today's drill down, where we focus on one ETF. Eric, hit it.
Katie, today is a special day. We've got a very unique ETF here. It looks pretty plain vanilla, the U.S. microcap portfolio from DFA, DFMC. But look at this little hyphen ETF. It is the first ever ETF share class of a mutual fund that is in Vanguard. There's about 80 to 100 mutual fund companies that are dying to do this. This is the first one, the guinea pig, if you will. Interesting, it's microcap, more on that in a minute. Brand new, 1 million, 41 bips. It's priced the same as the institutional class of the mutual fund, which again, people like the I-class pricing, and that's what you get here. Let's look at the holdings. Now, microcaps, if you don't know, is basically the bottom 5% of the market by market cap, but it's actually a lot of number of stocks. So this holds 1,700 stocks. There's just a lot of small stocks you probably never heard of here. This is trying to pick the best ones to outperform an index, just like an active fund would. And if we look at the mutual fund this is based on, which is so old, it actually launched in 1981, right? So it has a huge track record that we're going to look at right now. And I compared it to the Russell 2000, which is the small cap index. And look at this, shocker. This thing is blowing it away, right? 11,000 versus 5,000. Now, to be fair, large caps beat both of those. But you can see that's a nice annual lift over small caps. I did not realize this. Microcaps, kind of a forgotten space. But we'll see what's going to happen here, Katie, whether the assets come in here from the mutual fund or it gets organic natural bites, yet remains to be seen.
Absolutely. Eric, thank you. And joining us to talk about this ETF, I'm pleased to say, is Joel Schneider. He is Deputy Head of Portfolio Management for North America over at Dimensional. Joel, great to have you with us. So a brand new ETF that has a 45-year track record. It's pretty cool to see this finally get across the line. Just to set the scene, tell us briefly, I mean, what problem is Dimensional trying to solve here in finally seeing an ETF share class of an existing mutual fund?
Yeah, hey, Katie. It was great to get this one across the line, and we're very excited about it, not just because we think that there's a big future direction of more ETF share classes, but specifically this strategy. If you look at its 45-year track record and you understand its origin story, it really was designed for institutional investors who were concerned that they had too much weight in US large cap stocks. And in that way, history repeats itself because that's a concern of investors today, right? The market's very top heavy, and what you want is a source of diversification, but that doesn't come with a compromise in terms of returns or tax efficiency. And this portfolio's track record of beating the small cap index by 150 basis points a year is just a really strong way, I think, to enter the ETF share class space.
Thank you. And you basically answered my question on why start with the microcap space as your first ETF share class. What is the goal here, to launch ETF share classes of every mutual fund that you have on offer?
So far, we have registered to launch 13 of them for our U.S. equity mutual funds. And we may have more coming in future offerings. But what we did is we talked to our investors. And really, our goal is to give financial professionals, so really we're thinking financial advisors of different stripes, we're thinking institutions of different stripes. Our job is to give them professional grade tools to accomplish the financial goals that they need. And what we heard from them across the board is that having an ETF share class of mutual funds would be very helpful. And what this does is it brings a lot of economies of scale, the ability to reduce expenses and other costs, it also just provides them more choice, right? They don't have to worry about, hey, I love this strategy, but is it available in a mutual fund? Is it available in an ETF?
Right.
How's it priced? We want that all to be the same. And so I think you will see more of this coming from us as well as others in the industry.
All right, the big thing here that I'm looking at is how much money moves over from the mutual fund into the ETF share class. With Vanguard, which was the real OG guinea pig, we thought about maybe 8-9% of the money going into VU was from the mutual fund investors. How much are you anticipating? Because this is going to be interesting, because we're looking at 10 trillion possibly that could move over. How will that work, and how easy is it for the user to just move their money from one share class to the other?
Yeah, there's two ways to convert your mutual fund share class to an ETF share class. The first way is a manual way, and that's slower, and the investor will need to work with their custodian to make that a tax-free conversion. But we've laid the groundwork so that can happen. So already our investors, if they go through that manual conversion, can make it happen in a tax-free way. Now, the second way to do it is the industry more broadly is working on a technical solution that will provide more automation around it. So investors will be able to go in, hopefully just click a button and make this happen. And that will come later in the year. So I think you're going to see probably slower conversions to begin with. And then once that more automated industry-wide solution happens, faster conversions.
All right, so we'll keep an eye out for that button here. Something I do wonder about, Joel, you think about these shares classes, it seems apparent what the benefit would be for the mutual fund investors now having the ETF share class on offer. Obviously, the tax efficiency of the ETF playing a big part there. It's not as obvious, at least to me, what the benefit for an ETF investor would be in this scenario. So maybe you can shed some light on that.
Yeah, so there's benefits to both sides. Like you said, there's benefits to the ETF class. There's also benefits to the mutual fund class. For an ETF investor, being able to have a strategy that really has two access points, but it's one pool of assets. And so that economies of scale allows for a reduction in cost. So you should drive additional cost efficiency here. And so from both sides, we think that this is a winning move. And also, one of the things that we're hearing from is that some of our standalone ETFs that specifically we launched about 5 years ago as index replacement strategies. So these are lower tracking error, but still designed to outperform. They've become incredibly popular. We call them our market series, and we have about $100 billion in them. Some of the investors that are using those ETFs are saying, hey, I've got other clients that need mutual funds. Can you launch a mutual fund share class of those? And so you're likely to see us launching mutual fund share classes of existing ETFs as well. So it goes both directions.
And before we let you go, Joel, I do want to talk a little bit about market makers. There has been some concern over whether, if we saw share classes really take off in a big way, if the market making infrastructure and the ecosystem could handle significantly more AUM and significantly more just listed ETFs. And I wonder, how you approach that conversation at Dimensional and, your broader thoughts when it comes to this industry.
Yeah, for the end investor, it's really critical that when they go buy or sell ETF shares in the market, that they're able to get good liquidity, tight spreads, good execution, and we can't compromise on that. So we spent a lot of time working with other members of the ETF ecosystem, so APs, market makers, to ensure that our clients will have a great experience when it comes to that. But that is something I think managers need to give a lot of thought to, because it's not necessarily a given that their strategy will fit well in an ETF wrapper and that they'll be able to provide that. So bringing the entire ecosystem along and having those deep relationships with those providers is really critical.
All right, Joel, great to get some time with you. That is Joel Schneider of Dimensional. And you can read all about this drill down, plus the latest in the ETF industry, when you subscribe to my weekly ETF IQ newsletter. That is Bloomberg.com/ETFIQ newsletter. It comes out on Fridays. But coming up on ETF IQ, the TV show, we're going to take a look at some of the latest ETF filings, launches, and liquidations. We'll speak with Brittany Christensen, SVP, Head of Business Development over at Tidal Financial, the platform building some of the newest ETF products on the market. This is ETF IQ on Bloomberg.
just about halfway through the trading day in New York. I'm Nora Melinda. Let's take a look at your midday movers. U.S. stocks are higher, but giving up gains in the session, with the S&P 500 sitting near its lowest level since market open. The gains started to lessen last hour when Iranian parliament speaker said in a post on X that no negotiations had been held with the United States. Iranian state TV said the U.S. had tried to negotiate with Iran through intermediaries in recent days, but the country had not responded to those requests. Meanwhile, the impact is already showing up in oil prices. Oil is falling with both Brent and WTI lower as the policy-sensitive 2-year Treasury yield retreats. And turning to corporate news, JP Morgan has kicked off an $8 billion junk bond sale to help finance a record leverage buyout of video game maker Electronic Arts. The deal includes a mix of secured and unsecured bonds across the U.S. and European markets. And finally, Apple shares are rising after a Morgan Stanley analyst said Apple is likely to see strong results for its iPhone product line based on a recent survey pointing to record consumer interest in purchasing new phones. Those are your midday movers. I'm Nora Melinda.
This is Bloomberg ETF IQ. I'm Scarlett Fu. Let's get you to the ETF life cycle, where we walk you through the 3 main stages of ETFs, from initial filings to final farewells. Step 1 is the filing. Cathie Wood's ARK Investment Management submitting paperwork for a biotech ETF. This will be an actively managed fund that invests in both domestic and foreign biotech firms. It's not clear how much overlap there might be with ARKG, the ARK Genomic Revolution ETF, which targets companies involved in gene therapy, bio-inspired computing, and molecular medicine. Step 2 is the launch. Alpha Architect offering an ETF solution for investors who want to exit existing investments without realizing gains that would trigger capital gains taxes. Ticker AAUA allows qualified investors to contribute their existing holdings in exchange for shares of a newly formed ETF in what's called a 351 exchange. And for some, the final stage is farewell. The Crane Shares Global Luxury Index ETF has shut down. Ticker KLXY launched back in September of 2023, but really never caught on with investors. Its total assets averaged $2.8 million during its existence. All right, joining us now with more is Brittany Christensen. She is SVP Head of Business Development at Tidal Financial Group, a white label ETF issuer. Brittany, great to speak with you. And I just want to get a sense from you what you're seeing as more strategies launch and investors continue shifting assets from mutual funds into ETFs. We just talked a little bit about the ETF share class of mutual funds now being on offer at Dimensional and soon at other firms. What are you seeing on your end?
Great question, Scarlett, and thanks for having me here to speak on this. I think what we're seeing is it's not just a flows story. It's a platform migration story. We're seeing the business become more global. We're seeing European managers such as Pictet bring their first U.S. products to market towards the end of last year. We continue to see that the narrative has changed from will I launch an ETF to when and how do I launch an ETF?
And I'm curious, I mean, following on that share class conversation, we were just having this discussion with Joel Schneider over at Dimensional, the idea that, there are concerns out there about market makers being constrained in this environment. We hear a lot about balance sheets and what capacity might look like. And I wonder, what that means for a white label issuer such as Tidal. Obviously, you have to work on behalf of a ton of different issuers with these market makers. I mean, how has the tone of the conversation with the market makers changed over the past several months?
It's a great question, Katie. I think one of the interesting things is the pace at which the market has grown and the number of parties that have to engage with the same limited number of market makers who support the liquidity of the ETF wrapper. One of the ways we try to help our clients is by consolidating those points, and the market making community, frankly, consolidating those touch points within the Tidal team so that when we speak to a market maker, we can talk to them about many of our clients' issues and try to sort of protect the lead market makers from being put in a position of education, right? One of the biggest challenges or learning curves that most mutual funds will have to go through is how to understand the primary and secondary market mechanics of an ETF. Most market makers who are currently supporting, the number of ETF products that trade on the secondary markets today simply don't have time for education education. So we step in and help educate our clients. We also use this sort of, let's call it weight of our ETF book to essentially help make sure that we have the right partners for the right products, because getting that fit right, who you're going to be a natural counterparty to, who's going to be best at hedging your specific strategy, are all very important in making sure that we get this match correctly.
Let's talk about the famous investors that have started ETFs. This has been a trend recently. Tom Lee, probably the most successful of them, almost $4 billion into Granny. Then you've got Dan Ives, Rick Reeder, Nouriel Roubini all have ETFs. But then some research shops like Sanford Bernstein have tried, but they had to close. They didn't get any assets. What is the difference between one of these types of more sort of famous research or active managers that has success versus ones that don't?
Great question, Eric. I think the challenge for many of those research providers is that you have an audience, an embedded investor base, but it's unclear how many of them would convert to becoming your ETF investor, right? And so when you go into this business, I don't think that you should rely on your research reputation alone. I think you should focus on building it as a business. We often say launching an ETF is not a hobby or a side quest. It is a primary business objective that should be approached thoughtfully, considering how you lean into those the reputation that you have as an investor or a research provider, and then using that to help market the fund, and where the fund is essentially simplifying an enablement for your investor to access that strategy.
Brittany, I wonder, has the question ever come up, are there too many ETFs? You look at something like gold, and there's a bunch of different ETF options out there. At some point, there's just, choice paralysis for a lot of people.
I think that's very fair, Scarlett. When we talk to the advisors who use our products, I think the ecosystem is also getting more complex for them to identify and understand which products they should be using, which maybe prevents them from using the most innovative or newest features that are out there. What I think we will continue to see, actually, the industry has done such massive expansion. I think you will start to see more contraction through acquisition and M&A. I think we're starting to see that trend more and more now with some of the larger shops looking for opportunities, such as Goldman and Innovator. When I think about the consolidation that will occur, I think that will be beneficial for advisors, but I also look at the innovation will continue to expand in the ETF space, and I don't expect us to stop launching products anytime soon. That will mean that the model implementation for most advisors and TAMP communities will become increasingly important to helping our user base and the advisor community make sure that they're structuring their ETF portfolios and strategies the right way to capture what their investors are looking for.
All right, Brittany, got to leave it there. Great to get some time with you. That is Brittany Christensen of Tidal. Now, coming up, it's time for an IQ test where Joel Weber puts our ETF knowledge to the test. Here is a sneak peek at one of those questions, and it's a hard one, about how many single stock ETFs exist. We'll try to find the answer when we come back.
Does that include levered funds? I guess it would.
I think it has to, but stay tuned. This is ETF IQ. This is Bloomberg ETF IQ. I'm Katie Greifel, along with Scarlett Fu and Eric Balchunas, and it's finally time for an IQ test where Bloomberg's Joel Weber is going to see whether Scarlett, Eric, and I really know our stuff when it comes to ETFs. Joel, you know him as the co-host of the Trillions podcast with Eric, but also the head of games at Bloomberg. And I have to say, every time I read that title, I am just charmed, Joel.
Well, let's have some fun together, shall we?
We'll try.
It's been a little rough lately.
I know.
Good to have Eric back.
I need
We'll see if that brings it up. Okay, what's the largest ETF by assets listed outside of the United States? If you could get a close-up on Scarlett's face right now, it's a great one. Vanguard Australian Shares Index ETF, the Tracker Fund of Hong Kong, Next Fund's Topics ETF, or iShares Core S&P 500 ETF. Katie, that's another look. We could do a close-up on that, too.
Well,
Let's do close-ups on each of your faces. What do you think?
I feel like it's not Vanguard, because Vanguard has had a little bit of trouble really penetrating the rest of the world. So
process of elimination. You can drop
this
one.
Approach.
I'm going to go with iShares.
Okay.
I'm going to go with Next Fund's Topics ETF because the Topics is pretty broad.
Okay.
It's close. I'm actually going to go with the other one, the B, the Tracker Fund of Hong Kong. This thing's like a freak. I don't know if it's the biggest, but it's up there.
What I love about this is that Scarlett is correct.
Oh, all right.
Yeah.
My first
You were
time.
looking for one. Oh, my God. Congratulations.
Yeah, to Scarlett. Yeah.
All right, chalk one up.
Let's see if she can keep it going. Okay, question
Pressure's on.
number
DOJ,
2.
That's why.
About how many single stock
boy.
ETFs exist?
This is hard.
This is new. There's a lot.
Thank you for that.
Yeah.
Okay. So I think
More than a little, less than a lot.
Okay, so I'm going to say that's B then.
Okay. All right, 150 to 200.
I'm going with B also.
Eric?
Oh, man, they are launching like crazy. I think 20% of the launches last year, out of 1,000, that's 200. I have to go with C.
Okay.
But some did liquidate, so.
True.
Okay, let's
I'm still
see.
sticking with
Let's see
C.
what our answer is.
Oh my gosh.
About
Wow.
386, according to Bloomberg
So I was
Intelligence.
directionally correct.
Yeah,
of
I
the three
mean,
of us.
directional didn't win, but
That was
that's okay.
that was a good one.
Okay, glad you like it. Saucy, let's bring it home. Question number 3. Which of these travel-themed ETFs is having the worst return so far this year? Is it A, jets, B, away, C, PEJ, or D, beds?
Oh, jeez.
Man.
All down. I'll give you that much.
Scarlett, why don't you go first?
I'm going to guess A because of the surge in oil prices recently.
Okay, there's some logic to this. Eric?
I'm going to guess B because that thing is always in the doghouse.
Okay.
Oh, God.
Katie? Does that help at all? Do you like
kinda.
the reasoning, or do you want to do
No, I
something
did.
on your own?
I want to get airlines in there somewhere. I do like going with hotel, but I think I'll go with C. Why not?
Ooh,
Okay.
one for everyone.
Eric, you
Wow.
something happened there. That was away. That was supposed to be B, away.
Oh, was it?
Yeah. So Eric,
Oh.
you were supposed to get that one. But that's
Oh,
okay.
thank God. Okay.
Yeah. All right. So, anyways, when we're not fact checking these things, we're making great quizzes. Go to QuizGo on the terminal or Bloomberg.com/pointed, where you can play around with some leverages and have some fun with more betting and news.
All right, plenty of opportunities for heartbreak there. Our thanks, of course, to Joel Weber. And before we go, President Trump is speaking to reporters right now in Memphis, Tennessee. So let's listen in.
Taken away from the ICE patriots who are responsible for getting rid of the criminals that Sleepy Joe Biden, the worst president in the history of our country, and his gang of thugs in the White House. You talk about weaponization. They weaponize everybody. When Pam looks at somebody, oh, it's weaponization. They've indicted me. What they've done to me and everybody else, it's a disgrace. They're the weaponizers, and what they've done to people, we can never let that happen again. We can never let them get away with it again.